We are on the home stretch. All we have left to do is our budgeted balance sheet. So let's jump in and get it done. All right, so I have my March balance sheet, and I just got this from over here. I just wanted to put it over here so I would have a comparative balance sheet, and also because I'm going to use some of these numbers, so I'm like, get them all on the same sheet, right? All right, so let's start with our cash. Well, we know our ending cash balance. It's on our cash budget. And it's the ending balance as of the end of June. Okay, cool. That was easy. Accounts receivable. What goes into accounts receivable? 70% of the current month's sales. So we know that our June sales dollars, 70% of our June sales dollars is going to make up our accounts receivable balance at the end of June. So I'm just going to go over to my budgeted sales dollars for June and multiply that by 0.7. And that gives me my accounts receivable. All right, my raw materials inventory, that is going to be my raw materials ending inventory at the end of June, which was right here, 2,100, but that's units, that's pounds. How much were we paying per pound? It was $12.70. So I'm going to multiply by 12.70 to get an error. That's terrible. 26,670. You're like, where did you get this 12.70, lady? Right here. Okay, that's how much we were paying per unit. It also told us right here, 12.70, and it told us somewhere else too. It like wanted to tell us that all the time, 12.70 per pound. Cool? All right, finished goods inventory. Finished goods. We're going to get that from our production budget. And our ending inventory in June is going to be 8,400 units. Remember, we don't put units on a balance sheet. We put dollars. Balance sheet likes the dollars. I like the dollar. Times 11.50 a unit. Okay, it's going to be the same amount that we use for cost of goods sold. Again, we got that right here. 11.50 a unit. Okay. All right, so and then we get to add up our current assets. Remember, those are the ones that we expect to convert into cash within a year. And we get 472.50. Our equipment. Okay, so our equipment at the end of March was 480. And then did we buy anything? We sure as heck did. If we go to our cash budget, remember in June we bought $55,000 worth of equipment. So our new equipment balance is 535,000. All right, how about depreciation? So depreciation keeps accumulating. So we had 90,000. How much should we add? Well, remember it said our only fixed overhead cost was $5,000 of depreciation a month. So we know we've added 5,000 a month. So we're just going to subtract from that 5,000 times 3 months, because there were 3 months in the quarter. We get accumulated depreciation of 105,000. Okay, so then we know that our net equipment cost as of the end of June is $430. So when we add our long-term assets of equipment to our current assets, $472.50, we get total assets of $902.50. All right, that's the number we're shooting for, because even though this is a budgeted income statement, our assets still need to equal our liabilities plus equity. You can't escape it. It is a forever truism of accounting. Accounts payable. What do we know about accounts payable? Well, we know that when we buy materials, we debit materials and credit accounts payable, and then we pay it off in the following month. So our accounts payable purchases in June will not have been paid yet. I mean, our direct materials purchases in June will not have been paid yet. And so that is going to be our accounts payable balance. So our direct materials purchases for June is $59,690. All right, short-term notes payable. Remember, those are zero. We paid them off. What happened to you up here? Huh. There it goes. All right. Income taxes payable. Remember we said that we had income tax expense every month, but we never paid it in cash. So we must have debited income tax expense and credited income tax payable. So our income tax payable, we're just going to grab that off our budgeted income statement. And our income tax payable will be the accumulation of all 3 months income tax expense, or $95,893. All right, that's going to be it for current liabilities. So let's add those bad boys up. All right, and we get current liabilities $155,583. Our long-term notes payable, we have not made a single payment on that, nor have we borrowed additional funds. We've been paying the interest every month. So it's going to be the same as it was in March, $200,000. So our total liabilities is going to be that long-term note payable plus our current liabilities for a total of $355,583. All right, common stock. I did not see anything when we were budgeting saying we were selling or buying back any stock. So we will assume that is unchanged and still $435. Retained earnings. What do we know about retained earnings? Beginning retained earnings plus net income minus dividends equals ending retained earnings. So our beginning retained earnings is the retained earnings as of the end of March, $31,580, plus net income. So we'll go to our income statement. And we had total net income of $178,087 minus any dividends we paid. So I'm going to go to my cash budget, and we paid dividends in May of $100,000. So our new retained earnings are $109,667. So I'm going to add up my total stockholders' equity, which is going to be my common stock plus my retained earnings. I get a total of $544,667. Here's the moment of truth. This tells us whether we're done or whether we got to go back to the drawing board. Our liabilities of $355,583 plus our stockholders' equity of $544,667 equals $900,250. Our assets equal our liabilities plus equity. Woo! All right. We are done with master budgeting. I hope you enjoyed this, and I will see you in the next module.